This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Planning and operational. So let me explain what it is, what we're talking about, and then how we actually approach it. And what it is, you may remember on the previous set of lectures on chapter 7, I spent a few minutes discussing our materials expenditure variance. Because when we calculated the materials expenditure variance, it turned out it was adverse. So we'd paid more per kilo than we were supposed to on the cost card. I think the standard cost was $4.50 a kilo. We'd ended up paying more. And I said there are several possible reasons that could have happened. It could have been the supplier had simply put the price up. And if they put the price up, we've got to pay more, adverse variance, but it's not our fault. We can't control it. On the other hand, it could have been that I called it bad buying. It could have been that our purchasing manager had gone to the wrong supplier or something and ended up paying more than we should have done. And of course that we can control. We've paid too much this month, but if he's been going to the wrong supplier, hopefully next month we can get him to go to the right supplier and pay less. We can control it. And so what would be rather useful in something like the materials expenditure variance would be to actually break it down and to say, well, how much have we lost through factors we can't control because the supplier put the price up? And separately, how well or badly has the manager done? The price went up. Did he pay even more or did he pay less? But to look at the two separate effects. And that's what planning and operational is. Planning, as you'll see, and I'll tell you why it's called that later, but as you'll see, planning is looking at the factors we can't control. If the price went up, the price went down. Operational is looking at effectively our manager's performance, things we can control. Did he pay the right new price or didn't he? Anyway, to hopefully make that abundantly clear and to show you how we calculate it, or them, can you turn to exercise 1? Excuse me. And in exercise 1, you'll see our original budget. We were expecting the standard cost per unit of products to be $7. Expecting each unit would take half an hour to produce at a rate of $14 per hour. So we didn't actually need all the information. If it's half an hour to produce, we should be paying, or we thought, the original budget, we'd be paying $14 an hour. There we go, $7 a unit. And we budgeted on producing 20,000. We actually produced 22,000. We actually worked 11,400 hours. And we actually paid $15.50. However, since preparation of the budget, the prevailing external labour rate has increased to $17.50. So maybe, generally in our industry, rates have gone up. It was no longer sensible to have budgeted on $14 an hour. Rates have gone up to $17.50. And if we've ended up having to pay $17.50, not really our fault. And we ended up only paying $15.50. But the point was, had we known that rates had gone up to $17.50 at the time we did the budget, surely we would have budgeted on $17.50, we wouldn't have budgeted on $14. So we're going to break it down. We're going to look at how much it's cost us as a result of the rate going up externally, and separately, how much cost or savings there been as a result of us paying less, as it turns out, than the new prevailing rate. Now, before I do it, I'd better make it clear that our two standard ways of calculating these variances that give different answers. And people argue as to which is better. There's a logic to both. I'm going to do it the way that CIMA prefers and the way you need for the exam. And the reason I mention it is that if you have by any chance studied this before anywhere, university, or you've already looked at some books on this, if they weren't CIMA books, you may have seen it done a different way and get a different answer. Be careful. Again, the way I'm going to do it is the way CIMA prefers. Okay? Anyway, let's look first of all at the planning variance. And for the planning variance, I'm not concerned with what rate we ended up actually paying. We're looking at the effect of the fact that we'd originally budgeted paying $14 an hour, and the prevailing rate, the general rate, actually turned out to be $17.50 an hour. And I say again, when I did the budget, had I known that, I would have budgeted, I think, on $17.50, and not on $14. However, it's a little bit funny, so watch carefully and do learn it, obviously. For the planning variance, we take our actual production, which was 22,000 units, because overall that's what the effect is on. And we say, well, how much would that have cost using what we call revised standard hours at the original standard cost? Now, in some ways, a bit unnecessary here. When I say revised standard hours, we'd originally budgeted on each unit taking half an hour. There's no mention in this question of that needing to change for any reason. Presumably, we still expect it will take 0.5 hours. And when I originally did the budget, we thought we'd be paying $14 an hour, and therefore I'd now be expecting, on original figures, to pay 154,000. However, although we originally budgeted on paying $14 an hour, yet again, and I keep saying it, the prevailing rate's now up to $17.50. So we what we call revise our budgeted figures. Again, we take the actual production of 22,000. Standard hours hadn't changed from the original budget, so 0.5, so we're still expecting to take 11,000 hours. But we revise the standard cost. Not worried about not worried about what actually ended up happening, but had we known, we'd have revised it to this new rate of $17.50, which would therefore have led us to expect to pay $192,500. And so, you could say, your working is different by all means. Clearly, we're expecting we'd have to pay an extra $3.50 an hour, or in total, the difference is $192,500 minus $154,000, $38,500. Adverse, it's revised upwards. That's what we'd now be expecting. Okay, that's the planning variance, and that again is something we can't control. Much more importantly to us, is to look at how our managers performed, the operational variance. And for the operational variance, we now calculate it exactly the same way as we do with basic variances, exactly the same way, except there's no point, I think, clearly in comparing the actual cost to our original standard cost. It's been revised. Had we done a new budget, we'd have been budgeting on here £17.50 an hour. But we do it exactly the same as normal, comparing what we actually spent to what we should have spent using the revised standard. And so how did we do it with basic variances? We took the actual hours worked at actual cost. How many hours did we work? 11,400. How much did it actually cost? 15.50. So we actually spent is that right? 176,700. Can't be. 11,400 times 15.50. Yes, it is. 176,700. And what did we do? We compared it with actual hours at standard cost. But the one difference, and if you've understood me at all, I think very easy to remember, is that having revised the standard cost and saying a better standard is that 17.50, it's actual hours worked at revised standard cost. So 11,400 worked. The revised cost, we expected to pay 17.50 now. And so you'd have expected your manager to pay 199,500. The difference, 176. The difference, 22,800. And that's favourable. The manager has done better than we now expect. Now, well, there we are. Before I leave that example, though, don't add them together and try and reconcile it or anything. You can't. That's why there are different ways, or certainly another way of working out the planning variance. I don't want to confuse the issue, but this is the way CIMA expects. Operational is calculated exactly as we do in basic variances, no difference at all, except we using the revised standard cost. It's planning variance where things can be done differently, but anyway, I've shown you the workings. As to why they're called what they are, I think operational variance, which you were more concerned with in real life, I think the name's fairly obvious. It's how well we're operating. That if you're measuring your manager's performance, it would be silly comparing what he spends with the original standard cost because it's changed. It turns out he's actually done quite well. He spent less than we would now have expected. The planning variance, we're normally less concerned about. I think the relevance is why it's called planning. We've realised that because of rates going up, it's costing us 38,500. Now that bit of it we can't control. You know, if rates go up, rates go up. We can't force general wage rates to go down. But when you realise that, the one thing they might consider doing, they might look to ways to change their plans. What I mean is, they may say, oh, look, wage rates are going up so much. maybe we can use less skilled workers. It may take a bit longer, but if they're a lot cheaper, it may be worth doing that. Maybe we can get our workers to work faster or something. So you might look at ways of seeing, can you change your plans? You can't change what the general wage rate is, obviously, but they might consider changing plans for the future, like using a different type of worker. Anyway, there we are. It could be asked on anything. If you look over the page, there's exercise 2. Exactly the same idea, but it's materials. The budget production, 21,000. The standard cost per unit, 3 kilos at $3 kilos at $4. We actually ended up producing 10,000. We actually bought 33,000 kilos when we paid $4.20. But again, we need this revising. A global shortage meant that the external price for the material was higher than budgeted and should have been at $5.20. So even before doing any numbers, it turns out we really should have expected to pay $5.20, not $4. So we've got planning variance. Separately though, we now expect to pay $5.20. Our manager managed to buy it at $4.20. And so we've a favourable operational variance. It's exactly the same logic and same rules. So although I'll go through it, I suggest you pause this lecture and have a go yourself. Operational variance should be really easy. It's basic rules. Let's see if you can sort out the planning variance. I'll carry straight on. So I'll say pause the lecture, have a go, and then see if you agree. All right, I'll go through it. Exercise 2. I've talked through it a minute ago, so I won't repeat, but let's go to the planning variance first of all. This is the one that needs what you might call the most learning. The planning variance, we take our actual production, 10,000 units. We take our revised usage. Well, again, although I'm writing it generally here, in your sort of question, it'd be like this one, that the standard usage was 3 kilos a unit. There's no mention, there's nothing to tell us that that needed changing. And so we still expect, I'm not saying what we actually use, we still expect to use 3 kilos. And we cost it out at the original standard cost. So we should have been paying, or we did expect, sorry, to be paying $4. So on our actual production, we would have expected to spend 120,000. It turned out that the global price was higher, so we should have had a standard cost, had we known, of, what is it, $5.20? And so we compare the original cost to actual production, 10,000. The revised usage, we still expect to use 3 kilos, but we would now expect to be paying $5.20 a unit, a kilo, I beg your pardon, which gives us a total of 156,000. There seems to be something going wrong with my pen here, but still, oh dear, help. It's probably getting overheated. 150. Did I say 156? Yes. No, hopefully we're back to normal. And so, revising it, means you expect to spend 36,000 extra. And I hope obviously from the very beginning it's adverse. Well, now we've revised the figure to 520, the operational variance we do in exactly the same way as always, as we did with basic variances. And so what do? We take our actual purchases, which were actual purchases, 33,000 kilos, at actual cost. Actual cost was 420 a kilo, so in total we actually spent 138,600. And we compare that with what we should have spent, but using the revised standard. So actual purchases at revised standard cost, $33,000 kilos, $5.20. We were expecting them, having revised, we were expecting the manager to have paid 171,600. And of course, he's actually done well. There's a favourable variance of 33,000. Okay, so it's not hard. For, I think, the third time, but the last time, operational variance is exactly as always. With basic variances, we're just comparing actual cost with the original standard cost. With planning and operational, much more sensibly, actual cost compared with revised standard cost. Planning, well, I'm not going to repeat it all, but effectively, what you can see for yourself, we're comparing original standard cost with revised.
This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.